Of our analysis of fixed index annuities using the article written in Advisor Perspectives by Michael Edison and Robert Hoopshire. They just had written this the other day, as a matter of fact, in January 29, 2019. And a lot of good analysis. They use the Roger Ibbotson report on FIAs, fixed index annuities. He's a little bit more pro on it. And these guys are, I don't want to say con, but they make a couple points that you need to take into consideration as you're looking at your own fixed index annuity. So don't forget to subscribe down below, and let's just finish this up because I think you'll find it of interest. If you haven't seen the other two, I'll put the videos up there someplace. I always forget which side it is. So just watch. They'll go above my head, and you'll see the other two articles on here. So, all right, let's see what we got. So downside of the FIA. FIA, if you're just new to this, is fixed index annuities, equity indexed annuities, what they used to be called. The Athene FIA has serious downsides. Let me just wrap up briefly. Remember, so what Edison and Hoopshire came up with, they have 5 scenarios they basically looked at 2 different Athene fixed index annuities, and they very explicitly stated this is not necessarily representative of the entirety of the FIA world, but they used it. Now, the Ibbotson one on his article, which I'll go into next, which he talks about the pros of the fixed index annuities, that's a hypothetical. There is no, he's using just, there's not a real annuity that he's looking at. He's just using hypothetical, and at least some to be desired in that regard. But either way, and so what Hoopshire and Edison find is that basically of 5 different scenarios, 1 is the annuity, 2 is a 100% stock portfolio, 3 is a 60-40 stock bond portfolio, and 4 is a 12-year bond. The fixed index annuity did not do obviously as well as 100% stock, didn't do as well as a 60-40 stock bond portfolio, and basically is even Steven with a 12-year bond as well, or 100% bond portfolio is what they say. They're going to offer at the end of this article their easy strategy, so I don't know what that is. We'll jump into that now. But now we're talking about the downside. The first major downside is that the full paper value of the account cannot be, and that's again the walk-away money. Walk-away money. How much can I get from this annuity if I close the contract out today? Cannot be realized without paying a very substantial, though declining, surrender charge, noting that there are exceptions. And again, it's usually 10% of the account value after the first year, is typically for most annuities the way it is. A second downside is that the insurer reserves the right to change the participation rate or the annual fee, or both, as it so desires, within the bounds of the regulatory agencies. And I've seen a couple of these FIAs, forgot the name of the companies, and they both state that explicitly. We reserve the right to change your participation rate, cap rate, the fee, all that stuff. And just remember what we went through in 2008 with the home equity lines when the banks were pulling it back saying, oh, you thought it was 100% loan to value. We reserve the right in the tiny small print to say, no, it's 80% loan to value. So you got to pay up and we're going to restrict your line. Or I'll never forget my own credit card. I had a 0% thing through stupid Citibank. And then Citibank, and of course, remember, they got bailed out by us, the taxpayer. They reneged on that. They said, we reserve the right in there not to give you 0%. Now it's 14.99. And I mean, this was bad because I had just moved, just started a new job. And it was frightening. I was like, I'm not sure I can pay this. It was scary. We survived, but I'll never get that. So the idea that these insurers will never do that, and that's what the insurance proponents will say, oh, they never done it in 25 years. Yeah, Genworth used to say they never raised rates on their long-term care policies too. And guess what happened? They did. So just got to be careful. Thus, the initial participation rate and fee rate are not guaranteed to continue past the first 2-year period. Again, this is specifically to the Athene fixed annuity that we're looking at, fixed index annuity that we're looking at. I've looked at others and they said the same thing. If the investor finds a change in the participation rate and or fee rate unsatisfactory, the only way to opt out of the annuity is to pay the significant surrender charge. And remember, the surrender charge were significant. I think it's like 14% in the first year or something like that. We requested information from Genesis Capital, Athene, and Nexus as to the historical data for participation rates and fees for annuities that are already in force, but did not receive any responses. However, information we have received from independent sources suggests that Nexus has never reduced its rates. Okay. FIAs are not securities and not regulated by the SEC, but by state insurance commissioners, which is why people can say a lot of things that if you're a SEC licensed or representative or secured product, you could not get away with saying. I guarantee this will do better than bonds. Most likely this will do better than stocks. You can't say that stuff. If you're an investment guy, I guess in insurance you can because the state regulated. I don't know. Without doing the proper research, the buyer of the FIAs does not know, for example, the commissions being earned by the broker or the agent selling the product. We already talked about a bunch of different, you got all these different people getting their hands on your money that can only do one thing, which is reduce your benefit. A better alternative. The same pattern of investment returns offered by the fixed index annuity can be obtained by purchasing every 2 years a high quality corporate bond and a 2 years S&P 500 at the money call option. Okay. So you're basically hedging, you're creating your own hedge portfolio. No one's going to do that. So I'm not going to go into that. Let's just read it. I'll read it anyway. So basically you're buying a call in the SPDR ETF, which tracks S&P 500. We label this as a bond plus option strategy. For example, the most recent yield on 2-year corporate bonds is at the time of this writing 3.28. If coupons are reinvested at the 6-month Treasury bill, which at the time of this writing was 2.56, then an investment of 93 cents will accumulate after 2 years to $1. So again, on a corporate bond, you're not reinvesting interest. You're just not. I cannot stress this enough. You're getting a coupon is going into something, but it's not going back to the bond. So there's no compounding on corporate bonds or any bonds actually. All right, so basically what you're saying, after 2 years, this is called a zero coupon bond, essentially. After 2 years, I invest 93 cents in this, basically 94 cents, and after 2 years, it'll go to a buck, guaranteed, essentially, in this scenario, which, I put in 94 cents, and I get a buck back in 2. The remaining 6.3 cents can be used to purchase an at-the-money call option on the S&P 500. At this time of the writing, the S&P's price was $250 for just say, and the ask price for a 2-year call option in SPY was a strike price of $250, basically at the money, is $28. Thus, one can buy 11.5 cents of an at-the-money cost per unit of SPY, the SP 500 index. The 6.3 cents available to purchase a call option buys 54.8% of it. We can think that 54.8% as the rate of participation in the upside is likely that an insurance company offering a fixed index annuity uses this, or I guarantee they do. They're using the exact same kind of strategy to back up its guarantee of of your walkaway money. That they say, hey, we're going to guarantee that you don't lose money. The strategy guarantees the investor will not lose money over any 2-year period in the event of a loss in the S&P 500, but will gain 54.8% of any gains that should occur. Tables 1A and 1B compare the two. Let's take a look for the different strategies. Okay, so here's table 1. Annualized return over a 12-year period, expected 8% return on stocks. Fixed index annuity gives us 3.8. The bond plus option gives us 5.43. The bond gives us 4.47, and the equities give us 8%. So, you can see that. So basically they're saying going forward with the current market conditions with the 10-year bonds and whatnot, they're saying this is what you're going to, and whatever the bond rates that they're using, I guess a corporate bond, 12-year corporate bond is what they're using. Yeah, I'm sure it's a high-grade 12-year corporate bond, 4.47. Stocks 8, half and half, roughly 6.59, and the FIA at 3.88. Now they don't say there is risk, there's risk, and there's risk. On both these things have risk, the downside, and they also don't say you can't really get your money for 12 years. That's a pretty big deal. 10% and 8% return, expected return on stocks. Again, because partly your participation rate is only 65%. So if you get an 8% return on stocks on any given 2-year period, that's the average is going to be 3.88. I'm not look at the other 2 videos that talk about how the participation rate goes with the 2-year, the 6 2-year time frames when it comes to the up and down of the markets. Average annual returns on 10%. And what you'll see here is when the market gives us better future projections, the fixed index annuity does better. In this case, stocks give us 10, the bonds give us 4.5, and this gives us 4 3/4. So again, a 25 basis points increase for the fixed index annuity relative to the bond is that worth it? I don't think so. But I mean, at least you have no risk. I don't think it's worth it. But the average return on the bond plus option exceeds that of the FIA by about 1.5%. Yeah, I'm just not a big fan of the bond plus option because no one's going to do that. All right, conclusion. For an investor whose utility function involves a very strong aversion to loss of any principal, accompanied by the desire to participate in any upside, some fixed index annuities could be a good alternative. If such an investor is advised by an advisor charging as much as 1%, that advisor could truly justify their fee by enabling the investor to engage in a bond plus option alternative. I mean, I don't understand. Why don't we just look at what a 12-year government bond would be doing? I mean, you can go out in the market, see what's out there for 12 years. And if you think, look, my fixed index annuity is going to give me between 3.8 and 4.78, and I got to lock up my money for 12 years. I mean, a 12-year treasury right now is paying, well, a 10-year treasury is paying 2.73. I mean, so let's say a 12 years, we'll say 3%. You say, okay, I'll give you a government bond. I mean, there's no risk there because the government is a non-risk entity, and then I get a little bit less than a fixed index annuity. But that seems to me to be a better alternative. Or you can just do some ladder CDs if it's really that important. So at the end of the day, it's like, why even mess with all this stuff if the best I'm going to get in this regard is 4.78 or 3.88? And again, this is specific to that annuity. If I'm loss averse, then just buy CDs. I mean, yes, you're going to sacrifice some upside, but at least you can ladder them and have access to your money a whole lot quicker. We're talking about the other day, Navy Federal CD was paying 3.75 for 40 months. All right, so conclusion, they talk about so let's just tell you who these guys are again. Economist and mathematician Michael Edison is adjunct professor and visiting faculty at Hong Kong University of Science and Technology, chief investment strategist at Compendium Finance, advisor to mobile financial planning software company Plenty. He in 2007 he authored a book on the investment industry titled "The Big Investment Lie." Ooh, I got to read that. And his new book is three simple rules of investing. So it'd be interesting to see. All right, so that's the downside, and so that's a wrap up of the fixed index annuity, good, bad, and ugly. We'll look at Ibbotson's paper here in just a little bit, and then we'll give you the pros on it and see what that looks like. So again, I wouldn't do it. That's all there is to it. I don't see the value there. I really don't. Especially the more people you got trying to get in front of you and your money, the less you're going to do for sure. So as always, you like what you see, subscribe down below, thumbs up, comments always help me, and we'll see you guys next time at Heritage Wealth Planning. Thanks, guys.